Let's say you wanted to start investing. What exactly do you invest in? There is stocks, shares, bonds, NFTs, crypto, options, futures, forex, real estate, luxury goods. There's a ton of options out there. And if you do decide to focus on stocks, what stocks should you be buying? There's British Gas, National Grid, M&S, the list is endless. Coupled with the corporate jargon like dollar cost averaging, should you be investing in index funds, what are growth stocks, blue chip stocks, it can quickly become off-putting. And there is also the real fear that you may lose your hard-earned money. So in light of this, I'll attempt to break it down in the simplest form, how to invest in the stock market. I promise it is simple. All you need is your phone, an internet connection, and £1. This is probably a good time to smash the like button and hit subscribe, as it really motivates me to keep creating these videos. I've split this video into 4 parts. Part 1 talks about the idea behind investing and the basics of the stock market. Part 2 will cover the basic stock market terminology and the UK stocks and shares ISA. In part 3, we'll cover how to invest and a walkthrough of the Trading 212 app, not sponsored. And in part 4, we'll cover some of the common fears and questions when it comes to investing in the stock market. A quick disclaimer, I am not a financial advisor, and this comes from my experience and research, so this video does not in any way constitute financial advice. Part 1, the idea behind investing and the basics of the stock market. The whole point of investing is for your money to make more money. If you eat £100 in your wallet and you check that wallet a year later, you're going to get exactly £100. Well, you get £100 less inflation, but we'll get to that in a minute. If you put that same £100 in a savings account after the first year promotional offers, you can expect between 1% to 3% annually, which does not even cover the cost of inflation, currently sitting pretty at 4.2% in the UK. I'm sure you've heard of this thing called inflation. It's simply an increase in the price of goods while the purchasing power of your money decreases. I'll give you a perfect example. Let's say an iPad costs £100 right now in 2024. In the next few years, due to inflation, that iPad now costs £120. That lays the perfect introduction we need for investing in the stock market. The reason why we invest in the stock market is because there's a potential for long-term growth. Historically, the stock market has always delivered the best returns when compared to bonds, savings account, and some other investment vehicle. There is also the power of compound interest. If you started with an initial investment of £1,000 at an annualized interest rate of 10% and you only contributed £100 monthly for the next 35 years, your total additional contributions would have been £42,000, but you would have made £372,000 in returns. It is also one of the best ways to diversify your income. Say you've invested already in real estate, you have some money in your savings account, and you want to minimize risk. Investing in the stock market may be another way for you to do this. It is also, in my opinion, the best form of passive income, because not only do you make profits when the price of stocks go up, you also get paid something called a dividend. You do absolutely nothing to get both of these returns, so it is truly passive. And finally, it is the best way to protect your money from inflation. The stock market has provided a 10% annual return over time, so you get returns that outpace inflation and you protect the purchasing power of your money. Part 2, basic stock market terminology and the UK stocks and shares ISA. There are a lot of terminologies when it comes to investing in the stock market. There is day trading, swing trading, position trading, growth stocks, blue chip stocks. There are so many of them, but I'll only be getting into the relevant ones for this video. I do believe your understanding of the basic terms and an overview of how the stock market works prepares you to be emotionally and psychologically ready to invest in the stock market. So without further ado, let's start with a stock. A stock represents a share in the ownership of a company. Think of it as pizza. Let's say you buy a stock of British Gas for £10, which is the stock price. Technically, you now own a share of British Gas, which is a slice of pizza. A share refers to the single unit of ownership in a company. So it's basically the same thing as a stock. For instance, let's say I have invested in stocks. That could mean that I have a portfolio of shares across different companies. When a company decides to offer its shares for sales to the public, they need a place to list the stocks. That is the stock exchange. In the UK, we have the London Stock Exchange, while in America, we have the New York Stock Exchange. So now you're ready to invest in the stock market. How do you go about it? Do you just go to stockexchange.com/buy? It doesn't really work like that. You need a brokerage firm. And a brokerage firm serves as a middleman between the buyers and the sellers of financial instruments like stocks, bonds, equities, and other financial instruments. You can go with a traditional brokerage firm like Vanguard or an investment platform like Trading 212. Either ways, your money is protected by FSCS, which is the Financial Services Compensation Scheme, up to £85,000. So it really just boils down to your goals. Vanguard requires a single minimum investment or £500 or a monthly installment payment of £100. However, if you don't have up to that, you can decide to go with Trading 212, where you can invest as little as £1. And you also get free shares worth up to £100. I will share more on this in part 3. A dividend is a distribution of earnings paid either monthly or quarterly to shareholders of a company. An index fund tracks the performance of an index. An example is the widely known S&P 500, which tracks the performance of the top 500 companies in America. And an equivalent of that is the FTSE 100, which tracks the performance of the top 100 companies in the UK. Dollar cost averaging. This is my favorite investment strategy because you buy a fixed dollar amount, or in this case, a fixed pounds amount of a specific investment regardless of the price. So what this means is you don't try to beat the market or try to see when the stocks are up or down before you buy an investment. You just buy this investment regularly, say once every month, regardless of the price. Finally, because we're addressing how to invest from the UK, I want to talk about how to invest tax-free using an ISA. In the UK, there is a government-backed scheme called the ISA, which is the individual savings account with an allowance of £20,000. And there are 4 types of ISA. You have the cash ISA, the lifetime ISA, the innovative finance ISA, and the stocks and shares ISA. We'll be focusing on the stocks and shares ISA in this video. So with the stocks and shares ISA, you can invest up to £20,000 tax-free. So any returns you get on your investments is going to be tax-free. And the tax allowance is for every tax year. So the tax year in the UK runs from April 6th to April 5, and you cannot carry this tax allowance into the new year. So if you don't use your tax allowance for this tax year, you're not allowed to transfer it to the new year. It resets every year. So you get £20,000 tax-free every tax year. How to invest. Now that you have a more solid understanding of how the stock market works, how do you go about investing your first £100 or your first £1,000? I would recommend the same thing that Warren Buffett recommends, which is to invest in the index fund.
Of all the things that have happened since 1942, we've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million now.
Because it's going to require a lot of work to pick the right individual stocks. There are finance analysts, research analysts, maths wizard, whose job is to research these individual stocks, and even then the analysis is not always correct. So it's safer to invest in an index fund because you're betting on hundreds of top companies that have done well historically. I'm going to do a walkthrough of the Trading 212 app. Please note that there are other investment platforms out there, but I'm only showing you the app that I use. This is the Trading 212 app. Once you create an account and verify your account, then you can click on the deposit funds, which brings you here. You can deposit funds via an instant bank transfer or via card. On the home page, you can add stocks to your watch lists, and when you click on these stocks, you can see their performance over time, and you can see if they are paying dividends. You can see the financials of the company and other general information. You can also see the top winners, the top losers. You can see global markets. You can see most owned. So these are the shares that most people own on the app, and you can see the new shares that have been introduced on the app. If you click the people icon, you can see the community on Trading 212. Here, people are always reporting on their wins, like if they got paid their dividends. You can join any community, say dividend or Tesla. If you click on this Tesla community, these are people that are investing in Tesla and are very interested in Tesla news. You can use pies to allocate how you want your funds to be distributed in each of these stocks. So this is a bit more high level, but it's pretty straightforward. Someone here has a pie. You can see the investments they have in their pie. So if you're interested in this pie, all you just need to do is copy it and your funds will be distributed based on the stocks in this pie. So now I'm going to show you how to buy a stock or an index fund using Trading 212. I'm actually interested in buying the Vanguard S&P 500, which is the index fund that tracks the S&P 500. So what I just need to do is click on buy because the market is open. And now you can drag this to the number of shares you want. You can see the values changing as you drag. Or if that doesn't work for you, you can just click on the value and enter in an amount. This will show you how many shares you get. You can see that I have one share, 1.003 shares of Vanguard, and once I click buy, the orders will be executed at the best market price. This is because the market price is always changing. So the moment I click buy, they will execute that order based on the best available market price. So if you wanted to buy a share, is the same thing. Let's pick Coca-Cola, for example. If I was interested in this, the market is actually currently closed because this is a US stock. If we go to BP, this is a UK stock. I can click on buy and I can buy £1 worth of BP, or I can buy £1.80 of BP. That would give me 0.38 shares of BP. So you can do fractional shares on Trading 212. If I don't have up to £461, I can just buy whatever amount I have of that particular stock. How does your invested money make money? There are two ways. First, when the price of shares increases, maybe due to an announcement, new investment into the company, economic growth, trading activity, and also through dividends. There are companies that pay out profits to their shareholders either monthly or quarterly, and these are the two ways you can make money from your investments. Part 4. Risk, fear, and common questions when it comes to stock market investing. Obviously, if you're a beginner or you're in the early stages of investing, you have common questions and fears like, what if I risk all my hard-earned money? So if we go to google.com, we can see the S&P 500 index fund and the historical graph. And here you can also select the timeline that you're interested in. There is 1 day, 5 day, 1 month up until the max. So if we check on the max, we can actually see the historical graph. Here you have the famous 2001 dot-com bubble crash. See how the market has recovered down to this very famous 2008 crash. This was the 2008 recession timeline crash. And you can see the market recovering, going down a bit, recovering up until the sharp decline in 2020 as a result of the pandemic. If you had sold your shares at this point or at any point where the market was down, of course you would have realized your loss. If we do the same thing for the FTSE 100 company, that's the top 100 companies in the UK, we can view the exact same timeline as well. We have the 1 day, 5 day, 1 month up until the max timeline. Here you can see the famous dot-com bubble crash in 2001 right here, and then you can see the crash in 2008, which was the recession. While we're checking all of this timeline, you can see the pricing of the FTSE 100 index. You can see the pricing changing. That is because the market is always moving. All through this time period, the market has gone up 590.77%. So if you had invested £100 at this point, imagine what your £100 would be in 2024. First, the stock market works with the economy, and how the prices of shares rise and fall depends on different factors, including global news, the trading activity, announcements, elections, economy growth. It depends on so many factors. Definitely, some days will be better than others, but let's paint a real life scenario. Say you buy a share of the FTSE 100 for £50 and the next day the share falls to £30. If you panic and sell this share, now you've realized the loss. You have actually lost your money. But if you just wait it out and let the market recover, you could probably 1 times, 3 times, or 5 times your money, which is why investing in the stock market should be a long-term strategy. Realistically, I also do not think the top 500 companies in America or the top 100 companies in the UK will just go bust overnight. This is because they are professionals, everyday people going to work, bringing new ideas, starting new projects, making sure that the economy works. Aside from the stock market, I do believe that the best investment you can make is the ability to make more money yourself. That way you have more money to invest. And so I have an in-depth video right here on the 4 high income skills worth learning based on the top 1%. This is one of my best videos till date, and I hope you don't miss it. Hopefully you're already subscribed to the channel, notifications are turned on, and I will see you in my next video. Bye for now.